Hey, what's up, my friend? So, in today's episode, I want to share with you six things to look for before you place a trade, or six questions I ask myself before I place a trade. And this is coming from a price action trading context. So, if you're a discretionary trader, if you're a price action trader, then this episode will be really useful to you. Question number one: what's the current market structure? So, this question, right, I ask myself, right, is to know what is the current market structure. Is the market in an uptrend? Is it in a downtrend? Or is it in a range? And the reason I ask this is because if the market is in an uptrend, then I know that I want to look for buying opportunities. If the market is in a downtrend, then I know that I want to look for selling opportunities. And if the market is in a range, then I know that I can be both a buyer and a seller. Buy support, sell resistance, buy low, sell high, yada yada. Okay, so this is the first question. What's the current market structure? Number two, what's the higher time frame trend? This is important because let's say on the 4-hour time frame, the market might be in a downtrend, or it appears to be in a downtrend, but on a daily time frame, it's in an uptrend. So what this means is that on the 4-hour time frame, chances are it's just a pullback against the daily time frame. So this is important, right? Because the daily time frame will give you clue, right, to whether the trend that you're looking at on the entry time frame is likely to continue or break and reverse. Okay, so I ask myself, right, what is the trend on the higher time frame? So as much as possible, I want to be trading in the direction of the higher time frame trend. And also, right, if you recall earlier, one of the market structure I mentioned earlier is the market is in a range. Let's say the 4-hour time frame is in a range. All right, and you might be thinking, I can buy support, sell resistance. But let's say if you know that on the higher time frame, let's say the daily time frame is in an uptrend, then as much as possible, you want to be buying near the lows of the range, buying near the lows of support, because if the daily uptrend maintains, right, continues itself, chances are that range, right, the price will break out of resistance and resume the uptrend. So this is the power of understanding, right, where you are in the big picture, what's the higher time frame trend, and that's number two. Next one, number three, where are the areas of value on the chart? So here's the thing, right, just because the market is in an uptrend doesn't mean you want to buy immediately, because you want to know where are the areas of value on the chart. It could be at support. It could be at the 50-day moving average where the market has retested 3 times. It could be at the upward trend line. So there are multiple areas of value that you can define depending on the market condition. And this is the third thing I ask myself, where are the areas of value on the chart? Fourth thing, I ask myself, am I trading near an area of value? Okay, simply put, if you have identified support, are you trading near support or are you trading far away from it? And this matters because if you are trading far away from an area of value, your stop loss, right, will be wide. Assuming that you use a logical stop loss. Let's say setting it below support. If you're trading far from an area of value, your stop loss is going to be wide. And when you have a wide stop loss, right, it results in a poorer risk to reward on your trade. Why is that? Very simple. If you have a 500 pip stop loss, you need the market to move 500 pips in your favor for you to earn a 1-to-1 risk-reward ratio. If you have a 50 pip stop loss, all you need is for the market to move 50 pips in your favor for you to earn a 1-to-1 risk-reward ratio. Make sense? So all else equals, right, as much as possible, you want to have a tighter stop loss because it offers a more favorable risk to reward on your trade. And to get a tighter stop loss, you want to be trading near an area of value, not far away from it. Right, so the fourth question I ask myself, am I trading near an area of value or far away from it? Number 5, where might opposing pressure come in? Because, everything is not all rose and, and good stuff. If you buy at support, at some point in time, sellers are going to come in and, short the market because maybe the price is too high. So you want to ask yourself, where might opposing pressure come in? So again, let's, take it the other way around. Let's say the market is in a downtrend. You sell at resistance. Where might buyers come in? Where might opposing pressure come in? Because once you can so-called anticipate where might opposing pressure come in, it can help you better set a proper take profit level. So let's say you're a swing trader. You sold at resistance. And if you know that 300 pips away there is a swing low where buying pressure could come in, you want to have possibly a take profit at maybe 250 pips or 280 pips away from your entry price, just before the swing low, just before the price reaches that swing low where buying pressure could come in and push the price in the opposite direction. So once you can identify where might opposing pressure step in, this helps you determine ahead of time, right, where is a good place, right, to take profits. And finally, the last question is kind of like a bonus, right? what is the volatility of the market? Is it increasing or decreasing? Because here's the thing, right? Volatility in the market, it's always changing. It moves from a period of high volatility to low volatility and vice versa. So if you see the markets, right, let's say on a daily time frame, the candles, the range are very small, very tiny, market seems to be going nowhere, that's a sign. That's a sign that the market is about to make a move, right? Whether up or down, I have no idea. Nobody knows, right? But it's about to make a move. And this is important because if you know, right, that the market is about to make a move, then what you can do is you can go down to a lower time frame, to let's say the 4-hour time frame, to get an entry point, right? A good entry point, and to enter a trade and to hold for as long as possible, right? And see whether the market does break out in your favor. Okay, so what I do is that if I notice that on the daily time frame, the market is in a low volatility environment, I like to go down to the 4-hour time frame and look for potential trading setups, right? Maybe to buy the lows of support or sell the highs of resistance, because that's when I know that, the market, there's a good chance it's going to break out of the range, right? And volatility could expand in my favor and, offers, right, favorable risk to reward on the trade again. So again, right, volatility, expansion and contraction, pay attention to it, right? Yeah, low volatility market environment is where favorable trading opportunities are at, because your stop loss can be nice and tight. Whereas, market in a huge, crazy volatility environment, those are, I would say, not as favorable, because at that point, market is swinging wildly up and down. Your stop loss needs to be very wide to accommodate that wild swings. And as you know, when your stop loss is wide, right, it reduces the risk to reward on the trade, or rather, it's not as favorable. Okay, so a quick recap, right, to the 6 things I look for. Number 1, what's the current market structure? Uptrend, downtrend, or range? Number 2, what's the higher time frame trend? Number 3, where are the areas of value? Number 4, am I trading near the area of value? As much as I want to be trading near the area of value, not far away from it. Number 5, where might opposing pressure come in? And finally, the last one, 6th one, what is the volatility of the market? Contracting or expanding? So with that said, I've come to the end of this episode, and I'll see you in the next.